Disclaimer.
Hey, G here, and yes, I know what you're thinking. Of course, the Asian guy is covering China's silver play. But here's the thing. While everyone's watching TikTok ban headlines, China just quietly split the global silver market in half, and Wall Street's paper promises are about to get very expensive. Let me show you what's really happening to your money. On January 1st, 2026, something extraordinary happened in the global silver market that most Americans never noticed. While you were celebrating the new year, China quietly activated export restrictions that fractured the price of silver into two completely different realities. 1 ounce of physical silver now has two prices depending on where you're standing, and that gap is revealing something Wall Street hoped you'd never figure out. Here's what should grab our attention. In Shanghai, actual physical silver bars that factories can touch and use are trading around $78 to $80 per ounce right now. Meanwhile, in New York on the Comex exchange, where our financial institutions trade silver contracts, that same ounce of silver shows a price of just $71 to $74. We're looking at an $8 to $10 premium for real metal in Asia, while paper promises trade cheaper in America. This isn't normal market noise, and it's not going away. Think about what this means for a moment. Imagine walking into two different gas stations on the same street, where premium unleaded costs $4 at one pump and $3.50 at the other. You'd immediately drive to the cheaper station, fill up, drive across the street, and sell it for $4, pocketing 50 cents per gallon. That's called arbitrage, and it should happen instantly in efficient markets. Traders should be buying silver on Comex, shipping it to Shanghai, and collecting that $8 profit until the prices equalize. But that's not happening, and the reason why reveals a truth about our financial system that changes everything. The price gap exists because when traders try to pull actual silver out of Comex warehouses to ship east, they're discovering an uncomfortable reality. There isn't enough metal to move. According to CME Group warehouse reports, Comex registered silver inventories have collapsed roughly 70% since their 2020 peak. We're talking about the silver that's actually sitting in vaults, available for delivery against futures contracts. The metal that's supposed to back up all those paper promises Wall Street has been trading. China's new export policy didn't create this problem, but it just turned a slow-burning crisis into an immediate emergency. Starting January 1st, only large state-approved companies can export silver from China, and they need special government licenses to do it. The requirements sound technical, but they're deliberately restrictive. Companies must prove they can produce at least 80 tons of silver annually and maintain credit lines of $30 million. According to Ministry of Commerce announcements, only 44 firms qualified for these export licenses, covering 2026 and 2027. Think about what that means. Hundreds of smaller and mid-sized Chinese exporters who've been feeding silver into global markets for decades just got cut off overnight. Why does that matter to us? Because China controls somewhere between 60 and 70% of the world's refined silver supply based on recent industry analysis. They're not just a major player in this market, they are the market. When that much supply suddenly requires government approval to leave the country, the entire global pricing mechanism faces a test it was never designed to handle. Shanghai physical prices are telling us what silver actually costs when you need real metal delivered to a factory. Comex futures prices are telling us what financial institutions are willing to pay for contracts that mostly settle in cash. Let's talk about what's really happening in those Comex warehouses. The exchange tracks two categories of silver. Eligible inventory is metal stored in approved warehouses that meets quality standards but isn't registered for delivery. Registered inventory is silver that's been designated as available to fulfill futures contracts. According to recent CME data, total Comex warehouse stocks stand around 450 million ounces. That sounds like a lot until you realize only a fraction of that is registered and available for delivery, and that fraction has been shrinking dramatically. Here's where it gets interesting. The silver futures market operates on leverage. For every ounce of physical silver actually sitting in a Comex vault, there are hundreds of ounces worth of paper contracts circulating in the market. Industry analysts estimate the current paper-to-physical ratio stands somewhere north of 300 to 1. That means if even 1 or 2% of contract holders decide they want actual metal instead of a cash settlement, the entire system faces a delivery crisis it cannot solve. December 30th, the day before China's export restrictions took effect, CME Group published something that should concern every American with retirement savings tied to commodity markets. They issued emergency rule modifications, granting themselves explicit authority to force cash settlement at prevailing futures prices when physical delivery becomes impractical. Read that again. The exchange gave itself permission to simply pay you cash instead of delivering metal, using whatever price they decide is prevailing if they run short on actual silver. They published this rule change before the market even opened for the new year, pre-authorizing default as a possibility. Now think about your own financial life for a moment. What if your bank sent you a letter saying they reserve the right to give you 80% of your account balance in cash if too many customers try to withdraw on the same day? You'd probably find a different bank, but in the futures market, this is just Tuesday, and most investors have no idea it's even happening. The industrial demand side of this equation makes everything more urgent. According to Silver Institute data, global silver consumption reached approximately 1.24 billion ounces in 2025, while mine production could only deliver around 1.01 billion ounces. That's a deficit of roughly 230 million ounces in a single year. This isn't speculation, it's mathematics, and it's being driven by technologies we're all using and demanding more of every day. Solar panels consume 20 to 30 grams of silver per module because nothing conducts electricity quite like silver at the microscopic level these photovoltaic cells require. Electric vehicles use approximately 10 times more silver than traditional gas-powered cars due to all the electrical systems, battery management, and power electronics. Your smartphone, your laptop, every LED light in your house, the 5G infrastructure rolling out across our country. All of it requires silver in ways that have no economically viable substitute at current price levels. When silver hits $2,000 per ounce, maybe manufacturers will desperately seek alternatives. At $75 per ounce, they just keep buying. Here's the part that keeps commodity analysts up at night. Roughly 70% of silver production comes as a byproduct of mining copper, zinc, and lead. That means silver supply can't respond to price signals the way normal commodities do. When silver prices double, copper miners don't suddenly produce more copper just to get more silver byproduct. They mine copper based on copper economics, and silver comes along for the ride. New mining projects take 8 to 12 years to develop, even if companies wanted to respond to silver demand, and global ore grades have been declining for decades. Shanghai futures exchange inventories tell us what's happening on the ground in the world's largest silver-consuming nation. According to exchange data, their warehouse stocks hit 715 tons in late December, the lowest level since July 2016, and down roughly 86% from their 2020 peak. Chinese factories are pulling silver out of warehouses faster than it can be replaced because they need it for actual production right now, not next month or next quarter. The Federal Reserve injected $34 billion into the overnight repo market on December 31st, according to their daily operations data. That's 8 times higher than the $4 billion level just 2 days earlier on December 29th. Why does the Fed suddenly need to pump emergency liquidity into the banking system on New Year's Eve? Industry analysts estimate that silver serves as collateral behind somewhere between $200 and $250 billion in derivative exposure across the U.S. banking system. When the physical backing for those derivatives disappears because China stopped exporting and Comex warehouses are running low, stress shows up in unexpected places. This is where our story turns from interesting to urgent. We're watching a repricing event happen in real time, the kind that comes along maybe once or twice in a generation. Physical silver in Asia is demanding a premium because buyers need actual metal and supply is genuinely tight. Paper silver in New York trades cheaper because the financial system is built on the assumption that most contracts will settle in cash and nobody will actually ask for delivery. What happens when that assumption breaks? We're about to find out, and the timeline is compressed into the next few weeks. January is a delivery month for Comex silver futures, and the math simply doesn't work anymore. The story Wall Street has been selling us for decades is that futures markets provide efficient price discovery for commodities. The price on Comex represents what silver is really worth because sophisticated market participants trade billions of dollars daily based on supply and demand fundamentals. But what if that price only works as long as nobody actually wants the metal? What if the real price is whatever physical buyers in Shanghai are willing to pay for silver they can actually put on a truck and deliver to a factory? If that's true, then our entire understanding of commodity markets is built on a foundation that is currently cracking under pressure we can measure and track. This isn't about conspiracy theories or market manipulation in the traditional sense. This is about a system that was designed to work one way, encountering circumstances it was never built to handle. China, controlling 70% of refined silver supply, was always a vulnerability. Industrial demand, growing faster than mine production, was always going to create deficits eventually. The paper-to-physical ratio, climbing above 300 to 1, was always going to be tested at some point. What makes January 2026 unique is that all of these factors are colliding simultaneously, and the fracture between physical and paper prices is showing us the truth in real time. The question isn't whether silver reprices. The question is whether Comex maintains credibility as the global benchmark when Shanghai is clearly showing us a different reality. Let's talk about why this isn't just another commodity squeeze. The mathematics behind silver's supply deficit are brutal, and they're getting worse in ways most investors completely misunderstand. This is about the physical world running out of a metal that modern civilization literally cannot function without, while our financial system pretends everything's fine. According to the Silver Institute's World Silver Survey, global silver demand hit 1.24 billion ounces in 2025. Total supply could only deliver about 1.01 billion ounces. That's a 230 million ounce deficit in a single year. We've been running structural deficits for 5 consecutive years, drawing down above ground inventories to meet demand. Eventually, you run out of inventory to draw down, and that's exactly where we are. Here's what that deficit looks like in your daily life. Solar panels consume 20 to 30 grams per module, and installations are accelerating worldwide because governments are subsidizing renewable energy. Electric vehicles use 10 times more silver than traditional cars for battery management systems, power inverters, and charging infrastructure. Ford, GM, Tesla, every automaker ramping up EV production is competing for the same shrinking pool of available silver. The US government designated silver as a critical mineral in November 2025, recognizing it's essential for defense electronics and grid independence. That's not a buying recommendation, that's a national security warning. The delivery mechanics reveal why this forces a reckoning. When you want to take delivery of silver on Comex, the exchange is supposed to transfer a warehouse receipt representing actual bars in CME-approved vaults. The system works as long as there's enough registered inventory. But registered silver has been bleeding out for years. According to CME warehouse reports and Schiff Gold analysis, we are at the lowest registered inventory levels in over a decade, while open interest sits at historic highs for January. Think about this scenario. You're a Chinese manufacturer needing 5,000 ounces for production. Buy a Comex contract at $72 and hope they deliver, or go to Shanghai Gold Exchange, pay $78, and know for certain you'll get physical bars. This is why the premium exists and why arbitrage isn't closing it. The metal is not flowing from Comex to Shanghai because there is not enough in Comex warehouses to flow. History gives us a playbook. In 1980, the Hunt brothers drove silver from $6 to $49 per ounce. Comex responded by implementing Silver Rule 7, limiting traders to liquidation-only positions. Margin requirements got hiked repeatedly. The price collapsed from $50 to $11 in 2 months. In 2011, CME raised margin requirements 5 times in 8 days, increasing capital requirements by 84%. Silver crashed from $48 to $32 in less than 2 weeks. Notice the pattern? And when exchanges face delivery stress, they change the rules to protect the system rather than honor contracts. That December 30th rule modification by CME Group wasn't random. It was preparation for a scenario where delivery demands exceed available inventory, and they need legal cover to force cash settlement instead of physical delivery. The Federal Reserve's overnight repo operations tell us something unusual was happening as restrictions took effect. December 29th saw $4 billion in operations. December 31st jumped to $34 billion, an 8-fold increase in 48 hours. According to Bank for International Settlements data, precious metals serve as collateral behind hundreds of billions in derivatives across our banking system. When physical backing disappears because China stopped exporting and Comex warehouses are running low, stress shows up fast. Mine production faces geological realities that don't care about prices. According to U.S. Geological Survey data, roughly 70% of silver production comes as byproduct of copper, zinc, and lead mining. When you want more silver, you can't just open silver mines. You have to mine more copper. Copper mining decisions are based on copper economics, not silver. If copper demand stays flat while silver demand surges, silver supply can't respond. It's structurally locked to other metals' production cycles. Recycling won't save us. According to Silver Institute data, recycling contributes roughly 180 million ounces annually, and that number has been flat for years. Unlike gold sitting in vaults, silver gets consumed in tiny quantities across millions of products. The silver in your smartphone isn't economically recoverable when you throw it away. Silver in solar panels is locked up for 25 years on roofs. Until silver hits several $100s per ounce, recycling won't scale enough to matter. China's 44 approved exporters represent a deliberate choke point. Companies must demonstrate 80 tons annual capacity and $30 million credit lines. Those thresholds were designed to exclude hundreds of smaller exporters who have fed metal into global markets for years. China consolidated control into large state-approved entities that export when and how much Beijing decides, not when markets need the metal. Put yourself in a Comex clearing member bank's position right now. You've written short positions representing millions of ounces. Contracts are coming up for delivery in January. Chinese suppliers now need export licenses they don't have. Comex warehouses show registered inventory at multi-year lows. Shanghai shows $8 to $10 premiums, meaning sourcing metal there to deliver against New York contracts loses money on every ounce. What do? You hope the exchange invokes emergency settlement rules and lets you pay cash instead of delivering metal, even though that defeats the entire purpose of a futures contract. This is the mathematical box Comex is trapped inside. Either honor delivery requests and drain remaining inventory to zero while premiums explode higher, or invoke cash settlement and admit the exchange can't function as a physical delivery mechanism. Both damage credibility, but the second option keeps the system operating. The first triggers a short squeeze where prices gap violently as shorts scramble to cover positions they can't deliver against. These situations resolve quickly once they break. The Hunt brothers' squeeze took 9 to 14 days from peak chaos to forced deleveraging. The 2011 cycle played out in under 2 weeks. These are rapid repricing events where decades of assumptions get tested and broken in days. We're watching early stages with Shanghai premiums widening and inventory showing stress, but the acute phase hasn't hit yet. When it does, the people who understand what's happening will be positioned correctly, and everyone else will be reading headlines wondering what just happened to their accounts. Now let's map the timeline and calculate what happens next, because this isn't speculation anymore, it's mathematics playing out in real time. January is a delivery month for Comex silver futures, and the first notice day was January 2nd. That's when contract holders who want physical delivery officially notify the exchange. The delivery period runs through the end of the month, but the critical stress points happen in the first 2 weeks, when the exchange has to match delivery requests with available metal. Here's the calculation that should concern everyone watching this market. According to CME open interest data, January contracts represent exposure to tens of millions of ounces of silver. The exact registered inventory available for delivery sits somewhere around the low tens of millions based on recent warehouse reports. Now, under normal circumstances, only a tiny fraction of futures contracts actually go to delivery. Most traders roll their positions forward to later months or settle in cash. The futures market functions as a price discovery and hedging mechanism, not primarily as a physical delivery system. But these aren't normal circumstances. The paper-to-physical ratio tells us how leveraged the system has become. Industry analysts tracking Comex data estimate we are currently running somewhere between 300 to 356 paper ounces claimed for every physical ounce actually in the warehouse and available for delivery. Think about what that means in practical terms. If even 2% of contract holders decide they want actual metal instead of cash settlement, the math breaks completely. 2% of 350 is 7, meaning you'd need 7 times more silver than exists in the warehouse just to satisfy that tiny fraction of delivery requests. Why would contract holders suddenly demand physical delivery when they normally don't? Because the Shanghai premium is showing them that physical silver is worth $8 to $10 more per ounce than Comex paper prices. Because China's export restrictions mean they can't source replacement metal from the world's largest supplier. Because registered inventories are at decade lows and still declining. Because every day they wait, the premium might widen further. The incentive structure has completely flipped from our roll your contract forward to take delivery now before it's impossible. Let's walk through what happens over the next few weeks based on historical patterns and current market structure. First notice day was January 2nd. Between now and roughly January 15th, we're in the window where delivery requests get matched with available inventory. If requests stay normal, maybe 5 to 10% of open interest actually demanding delivery, Comex can probably muddle through by drawing down registered stocks and hoping some eligible inventory converts to registered status to fill the gap. But if delivery requests spike to 15 or 20% of open interest because traders smell blood in the water, that's when the exchange faces an impossible choice. They can attempt to honor all delivery requests, which would completely drain registered inventory, and potentially force the exchange to source physical metal from Shanghai at premium prices just to settle New York contracts. That would be admitting Comex prices are fiction and Shanghai is reality. Or they invoke those emergency cash settlement rules they published December 30th and force contract holders to accept cash at Comex prices, even though physical metal trades $8 to $10 higher in Asia. History tells us exchanges choose option 2 every time. The London Metal Exchange did it with nickel in March 2022, when prices spiked from $25,000 to over $100,000 per metric ton in hours. The LME simply canceled trades and suspended the market to prevent the exchange from collapsing. Comex did it in 1980 with the Hunt brothers by changing margin rules to make it impossible to maintain long positions. They did it again in 2011 by hiking margins 5 times in 8 days. When the system faces existential risk, the exchange protects itself and forces cash settlement on participants, even if it destroys the market's credibility as a physical delivery mechanism. The critical window we're watching is roughly January 6th through January 20th, based on how these delivery cycles typically play out. That's when the bulk of delivery matching happens, and when stress becomes visible through inventory movements and price action. If we see registered inventory dropping sharply, multiple percentage points per day, that tells us delivery requests are exceeding normal levels. If we see the Shanghai premium widening from $8 to $12 or $15, that tells us physical buyers are panicking and willing to pay any price for guaranteed metal. If we see Comex starting to invoke force majeure clauses or announcing special margin requirements, that tells us the exchange sees trouble coming. The outcome splits into two possible paths, and both fundamentally change the global silver market. Path 1 is Comex maintains the pretense of being a physical delivery market by allowing prices to spike dramatically to ration the limited available inventory. We're talking about silver potentially jumping from $75 to $120 or $150 in a matter of days, as shorts scramble to cover and longs refuse to sell except at prices that reflect true physical scarcity. This is the free market solution, where price discovers the level where supply and demand actually balance. Path 2 is Comex invokes emergency settlement rules, forces cash settlement at prices it determines are fair, and effectively admits it can no longer function as a physical delivery mechanism for silver. In this scenario, Comex prices might stay relatively stable around current levels or even decline as forced liquidations hit, but the Shanghai Gold Exchange and other physical markets completely decouple. Physical silver trades at $80, $90, $100 per ounce in Asia, while Comex paper contracts trade at $70 to $75. The market splits permanently between paper silver and physical silver, just like we're already seeing early stages of today. Which path happens depends on decisions being made right now in clearing member banks and CME group headquarters. Are they willing to let prices run to clear the market naturally, accepting that some participants will face massive losses on short positions? Or do they prioritize system stability over price discovery, force cash settlements, and accept that Comex loses credibility as the global silver benchmark? Both options are bad, but path 2 at least prevents a full-blown crisis where major financial institutions might fail due to silver derivative exposure. Here's what this means for regular Americans trying to understand how to position themselves. If you own physical silver, coins, or bars sitting in your safe or in allocated storage where you know exactly which bars are yours, you're holding an asset that's repricing higher, regardless of which path the market takes. Physical premiums are already elevated and likely going higher as more people wake up to the delivery constraints. If you own silver ETFs like SLV that hold paper claims or unallocated metal, you're exposed to counterparty risk if the fund can't actually source physical metal when needed. If you own Comex futures contracts, you're betting the exchange honors delivery or pays you cash at a price that reflects reality rather than the suppressed paper price. The industrial companies that need silver for production are the most exposed here. A solar panel manufacturer that locked in supply contracts at $70 silver faces disaster if physical market prices jump to $120, while their contracts get cash settled at $75. They can't build panels without actual metal, and suddenly they're scrambling to source silver at whatever premium physical markets demand. This is how supply chain crises cascade through the real economy, even when financial markets think they've contained the problem through cash settlement. The Federal Reserve and Treasury are watching this closely because silver's role as collateral in the banking system means stress in silver markets can transmit to credit markets and broader financial stability. That $34 billion repo injection on December 31st wasn't coincidence. When banks get nervous about collateral values and derivative exposures, liquidity freezes up and the Fed has to step in. If silver stress intensifies through January, expect more emergency liquidity operations that most Americans never hear about, but that signals serious problems behind the curtain. China is playing a longer game here that goes beyond just silver. They've implemented similar export restrictions on rare earths, tungsten, antimony, and other critical minerals. The strategy is clear. Control the physical supply of materials essential to modern technology and use that control as geopolitical leverage. While America debates TikTok bans and trade policies, China is quietly cornering physical supplies of the materials we need for everything from solar panels to defense systems. Silver is just one piece of a much larger resource competition that will define the next decade of global economics. So what's the bottom line for those of us watching this unfold? The price gap between Shanghai physical and Comex paper is a symptom of a system breaking under pressures it was never designed to handle. The next 2 to 3 weeks will reveal whether our commodity markets can still function as physical delivery mechanisms or whether they've become purely financial casinos disconnected from the real world. Either way, the relationship between paper claims and physical assets is being tested, and the people who understand the difference will navigate this successfully, while others wonder what happened. This isn't about panic or fear, it's about awareness. Our financial system has built enormous leverage on top of physical assets that are increasingly scarce. When that leverage gets tested, prices adjust violently and quickly to reflect reality. We're watching that adjustment happen right now in silver, and the lessons apply far beyond just one metal. The January delivery period will show us whether exchanges can still deliver, or whether we're entering an era where physical and paper markets price completely differently. Pay attention to the registered inventory numbers, watch the Shanghai premium, and understand that when systems built on assumptions face reality, change happens fast. The story of silver in January 2026 is really the story of what happens when paper promises meet physical limits, and that's a lesson worth learning regardless of whether you own an ounce of silver or not. If you made it this far, you're the kind of person who wants to understand what's really happening behind the headlines, and that's exactly who this channel is for. Hit subscribe so you don't miss what unfolds next in this silver story, because I'll be tracking every warehouse report and price move through January. Your support keeps this analysis independent and focused on truth over narratives. So if this added value to your understanding, let me know with a like.